first, in case you hadn't heard, tomorrow is Fed Day. Steve Liesman lays out the big picture from our CNBC Fed survey. Steve.
Wall Street expects the Federal Reserve to cut interest rates tomorrow amid growing concern about economic weakness, recession fears, and the trade war. 100% of respondents to the CNBC Fed survey see the Fed cutting rates by a quarter point after it announces results of its September meeting. Nearly all expect another quarter point cut by year end. The problem is that forecasts for lower rates come with a reduced outlook for U.S. growth and an increased probability of recession. The chance of a recession in the next 12 months soared to an 11-year high of 32%, according to the survey. It was below 20% for most of last year. Growth is forecasted to decline as well to 2.2% this year from 2.5% in 2018, and it sinks to just 1.8% in 2020. Economist Joel Naroff writes in response to the survey, quote, "A trade war that continues into next spring or summer almost certainly causes a recession that's likely to spread worldwide." Now, not everyone agrees. Richard Sichel, senior investment strategist at the Philadelphia Trust Company, says recession talk has been overdone. Yes, there has been some slowdown in various economic indicators, but the outlook for robust holiday spending is good based on the high level of consumer confidence. That should drive growth and stocks higher. For now, respondents to the survey see very slight gains ahead for stocks, but continued low interest rates. The question is whether Fed rate cuts will be sufficient to offset the negatives from the trade war and global economic weakness. The high level of the stock market amid continued forecasts for ever lower interest rates suggests the market's betting the Fed is going to win this fight. Back to you.
All right. Thank you. Leisman. All right, let's trade it. We already talked about this, BK. You know, if coin was spelled with a K, you could be Bitcoin. Brian.
I could be.
So I was kidding.
I hadn't thought about that.
I don't know if you thought about that.
I thought
no one's ever said that.
I was kidding. As you're debasing your currency from lowering rates and with 3.5% unemployment, isn't Bitcoin a way you could trade it, or gold?
Yeah, Bitcoin or gold, and that's what you're seeing in both of those markets. I mean, as much as I don't want to see them debase currencies, as a Bitcoin holder, I'm happy as can be that they want to do that. So that's certainly one way to play it. But if you think about what the problem the Fed has right now, or one of the problems, is that the yield curve is still very flat. And so they want to get the banks lending again. So that's what I'm going to be watching. You look at the regional banks tomorrow. Look at KRE, which is the regional bank ETF. You want to see if that yield curve starts to steepen. That should be positive for the bank. So I would look at KRE, see if you can buy it on a breakout in the afternoon. The other thing I would say, and this is going to be controversial, is that I wouldn't be surprised if the Fed cuts rates and the dollar goes higher.
Oh!
There you go. Boom.
Controversial.
Well, listen, he's wacky. You just never know what he's going to say at any time.
I think we put this in context. Let's go back and re-examine how closely this period parallels 94, 95. You had a very aggressive Fed in 94. I think Greenspan raised 7 times. You move to 95. You get a couple surprise cuts in the back half of the year. What led coming out the rate-sensitive cyclicals? I think when you look at the strength we've seen in home builders, the strength we've seen in semis, the banks. I mean, J.P. Morgan, I would argue one of the most important bellwethers in this market, is at all-time high. So I think we have to respect the message of the market. The wall to worry is high, whether it's Fed, China, oil, but stocks act well here. Respect that.
So, Joe, welcome, by the way. Nice to have you here.
Thank you.
What we've seen in terms of the eradication of the momentum trade, whatever that means, I don't think that changes. But to the Fed, so if they do a 25 and if they do a hawkish cut, that is something that I don't think this market is positioned for. Remember, the mid-cycle adjustment of the last Fed meeting was something that had the market somewhat perturbed. So depending on where you think the Fed is going to line you up in terms of their next move, I don't think that the markets are ready for that. And what Brian says is ultimately it would lead to a dollar positive environment. In fact, look at the dollar. I mean, the dollar closed today. It's a great chart, and it's not great for a lot of risk assets, but it's great for reflation, and it's great for asset prices.
You know, Joe, I think it comes down to the communication coming from the Fed itself. I mean, we've seen this time and time again, and we've had 2 situations where the communication from Powell was not good, and the markets reacted almost immediately. So is there going to be a quarter-point cut? Well, Liesman's got it at 100%. So apparently there's going to be a cut that's absolutely a quarter. Is that basically priced in? I think it is. But it's the communication, I think, that stands out. Now you look at volatility. Volatility is trading in the 14s. People are not scared right now. And where are they going to protect their portfolios? You brought it up at the very top. Gold and silver. I mean, you are seeing some of that. I know you brought up Bitcoin as well. I'm not in that world as much. But GLD, but GLD has been an absolute home run. I mean, this has been a move that started in May that has continued. It's pulled back a little bit, but I'd call that almost more of a consolidation move than a huge pullback. Can it find itself once again to start moving to the upside? Today, at one point, it was back over 142. Silver pushing towards 17. So there's a lot of different things going on right now.
And it's interesting that gold has moved actually with a relatively stronger dollar. I mean, usually gold has got that inverse, and that's pretty much broke this year. So what we've been seeing is a lot of macro funds hedging out the kind of this central bank risk with both gold and actually Bitcoin as well.
But I think when you look at all these macro trades, whether it's long yen or long gold or long German boons or long mid-cap software, it's been all the same trade all year long. What I think is underappreciated is the degree to which the last 3, 4, 5 months, some of these cyclical semis in particular have acted well despite economic concerns. I want to respect that message.
Yeah, I think if you saw how the semis closed, they closed at the highs. And you know, the oil headlines of the last 48 hours are ones that I think are more of a, kind of a red herring for investors that think this is going to lead to something substantial. I don't even think the Fed needs to acknowledge it tomorrow. I do think you have a case where it had people kind of gut check some of these trades that have been going on, and it's into kind of the value side of the cyclical chain. I don't think you're going to kind of early cycle cyclicals in the sense that we actually think that the economy is going to pick up. I think you're going after banks who have valuations that are very defendable, and as the yield curve has steepened in the last 3 weeks, banks have been the best trade.
The great thing about the hedge so far, at least so far, in terms of gold and silver has been the velocity of those moves, because that move has been so dramatic so fast that as in terms of a hedge, you don't have that much risk to the downside, and yet you have these huge, very rapid moves to the upside that are balancing out portfolios, almost like having a put. I mean, right now, that's been the put in my portfolio. I don't own any spider puts, even with volatility where it is right now, because the trade has been, and I think it continues to be, the protectional trade is GLD, SLV, and individual names along with the GDX.
The lows in yield are in. Does everyone agree with that or not?
I don't know about that.
I'm not sure how you can. I don't know if you're positing that, Joe.
I'm asking.
Throwing it out there, and I think it's difficult to say that considering where we were and considering the lack of confidence we should have in the ECB.
The 10-year was never that low in history, right? Never.
Well, we were 136 back in.
I'm sorry, the 30-year was never that low.
Right.
The 30-year.
Yeah, we said right, and. Look, the market has been extreme in terms of the move on the way down and the stream on the way up. We had 3 standard deviation moves for the bond market or things that you don't really see. To say that the fundamentals that took you lower, some of it was technical, but some of this, to me, was the ECB, was Germany, where bond yields were actually bringing us lower. Do you have a lot of confidence in the European banking sector right now? Do you have a lot of confidence in the ECB to engineer some kind of a stimulus package here?
As we're still in a cutting phase from the Fed, I think we will have bottomed in yields before they end cutting. It's already probably happened, I think. Would you buy the banks? I think we got to leave it go in a second. But Gunlock said buy Deutsche Bank if you think rates are. I just saw a flash. But buy it if rates are headed up.
That's out on the risk spectrum. But certainly the ECB has made a point to say we are not going to let the banks deteriorate. And you've seen a rally in Deutsche Bank. I would look at the regionals again. And again, if you get any type of steepening in the yield curve, that's going to be very positive for the banks.
The most important bank stock in the world is at a 52-week high, JP Morgan. They had these things on the ropes a few weeks ago. They should have stopped the fight, and boom, it came right back. You have to respect that message.
I'd go with the beta names in the banks, though. Not so much the regionals, because I want the big boys still. I'd go with Bank of America Citi. I own those. I think you own something in there, maybe both.
I'm long JP Morgan Citi and Bank.
I am not a JP Morgan. I love what they're doing. I love Jamie Dimon, but I still think that is at a value level, and the downgrade the other day made sense to me, the fact that they went to neutral. But I look at the other 2 names, and I think there's much more runway to the upside.
This is really easy, isn't it? I mean, for me to I was like,
you're good, man. You really are. You got it all.
You guys,
it's like having Andrew.
I'll tell you what. At some point, though, I think it's important to bring in another voice.
It's really easy.
We had a big bull on yesterday next to me.